So here's a list of some of the best Vanguard index funds you can buy at the moment. So to keep things simple, I will walk you through each one and explain what they are and provide all the information you need to make an informed choice. But before we dive in, let's take a moment to discuss why Vanguard is such a remarkable company. Because Vanguard is a pioneer in low cost investing and is committed to putting investors first. And this is really important. But I hear you say, but Maurice, doesn't every company claim that? Not really, and here's why. Because Vanguard was founded in 1975 by John Bogle, who revolutionized the industry by creating the first index fund, making investing accessible to everyone. Back then, the investment landscape was drastically different than today. Investors had to buy individual stocks to diversify their portfolios. And Wall Street was booming, and they were profiting significantly at the expense of investors who often were not aware of those hidden costs. So, John Bogle was the first to challenge the notion that you could consistently beat the market. His goal was to provide a low cost way for every investor to participate in the market and achieve an average market return without too much hassle. And today, Vanguard manages trillions in assets and continues to prioritize low fees, broad diversification, and long term success for its investors. And with this background in mind, let's dive into the list of the 5 best Vanguard index funds at the moment you can buy in 2024. And the first one is the Vanguard Total Stock Market ETF, the VTI. VTI provides exposure to the entire US stock market, including large, mid, small, and micro cap stocks. It's one of the most diversified US stock ETF available, capturing the full breadth of the market. The expense ratio is 0.03% and it's really low if you compare this with the rest of the market. So, if you have been following me for a while, you know that I have over 15 years of experience in the financial industry, helping clients grow their wealth smarter and faster. And one key insight I've gained during this time is that costs are one of the most critical factors in investing. Reducing fees can significantly impact long-term returns, making it essential to choose investment options that prioritize low costs. That's the reason why I'm a big fan of the VTI. So the 3 biggest holdings of the VTI are Apple, Microsoft, and Alphabet. So the number of stocks in the fund is over 3,600. So this means you are really diversified in the US stock market. This fund has a significant weighted exposure to the technology sector, accounting for 33% of its portfolio. And this concentration in technology highlights the fund's focus on companies that are positioned for growth and innovation, which can contribute to its overall performance. This fund has delivered outstanding performance with an annualized return of approximately 12.78% over the past 10 years. It's launched in 2001 and the fund has achieved an average annual return of 8.87% since its inception. This consistent performance showcases the fund's ability to generate strong returns for investors over the long term. So, VTI offers complete exposure to the US equity market, providing strong diversification and access to all sectors. Its low expense ratio and broad scope make it a solid foundation for long-term growth. Then we dive into number 2, the Vanguard S&P 500 ETF, the VOO. The VOO tracks the performance of the S&P 500 index, which includes the 500 largest US companies. It's a core holding for many investors who want exposure to large cap US stocks. Expense ratio is 0.03%, which is notable low compared to the industry standards. And as you know, the lower the fees, the more you keep of your investment returns. So this is why I highly recommend the VOO. The 3 biggest holdings are Apple, Microsoft, and Nvidia. The number of stocks in the fund are 503, providing substantial diversification within the large cap segment of the market. So VOO has significant weighted exposure to the technology sector with 31% of its portfolio. This focus on technology reflects the strength of large cap companies that are leading the market. VOO has delivered impressive performance with an annualized return of around 13.33% over the last 10 years. It's launched in 2010, where FU has achieved an average annual return of about 14.7% since its inception. This strong performance demonstrates FU's effectiveness in capturing growth of the largest US companies. So, why is this a great addition to your portfolio? The VOO focuses on large established US companies which tend to offer stability and reliable growth. It's a great option for investors who want exposure to blue chip stocks with strong historical performances. Then we dive into number 3, the Vanguard Total International Stock ETF, the VXUS. So, VXUS provides exposure to international stocks across developed and emerging markets, excluding the US market. This fund helps investors diversify their portfolio beyond the US equities. The expense ratio is 0.07%, making it a cost-effective choice for global diversification. And I have seen the benefits of diversifying internationally with hundreds of clients. Sometimes reducing concentration risk in US stocks can be important, and the VXUS offers a compelling way to achieve this, but it depends on your situation. The three biggest holdings are Taiwan Semiconductor Manufacturing, Novo Nordisk, and ASML Holding. Number of stocks in the fund over 8,600, ensuring broad exposure across various international markets. The region's exposure from the VXUS are emerging markets with 25%, Europe with 40%, and Pacific 26%. And when you look into the specific countries, the 5 biggest countries are Japan with almost 16%, United Kingdom with almost 10%, Canada with 7%, China with 6.6%, and India with 6.5%. The VXUS has delivered a solid performance with an annualized return of approximately 5.43% over the past 10 years. It's launched in 2011, and the VXUS has achieved an average annual return of around 5% since its inception. And the reason why VXUS may lag behind on FU and VTI is that the US stock market has generally outperformed the international markets over the past decade. And this trend is often attributed to strong economic growth, innovation, and the dominance of US technology companies, which make up a large portion of both FU and VTI. For example, companies like Apple, Microsoft, and Amazon have seen substantial stock price increases, boosting the performances of these funds. In contrast, the VXUS is more diversified across various sectors, which may not have experienced the same level of growth as technology did, but the question is always, how will they perform over the next 10 years? So there are cyclical periods in which the US and international markets outperform each other, and I tell you more about these cycles in this video. Then we dive into number 4, the Vanguard Growth ETF, the VUG. The VUG focuses on US large and mid-cap growth stocks, targeting companies expected to grow faster than the overall markets. So this fund captures high growth potential within the US equity space. So yes, as an investor, you need to be aware that growth ETFs can be potentially riskier and more volatile. So the expense ratio is 0.04%, which is competitive for a growth-focused fund. Investing in growth stocks can offer high potential returns, and VUG's low fees make it an attractive option for accessing this segment of the market. The 3 biggest holdings are Apple, Microsoft, and Nvidia. The number of stocks in the fund are 188, providing concentrated exposure to high growth companies. The VUG has substantial exposure to the technology sector, accounting for approximately 59% of its portfolio. This concentration aligns with the fund's focus on innovative high-growth companies, and the VUG has delivered exceptional performances with an annualized return of around 15.5% over the past 10 years. The fund is launched in 2004 and has achieved an average annual return of about 11.5% since its inception. So why is this a great addition to your portfolio? In my opinion, the VUG adds a growth-oriented exposure to the portfolio, focusing on companies with high growth potential. It complements the broader exposure of the VTI by targeting high-performance sectors and companies with strong growth potential. Then we dive into the last ETF, number 5, the Vanguard Total Bond Market ETF, the BND. The BND offers broad exposure to the US bond market, including treasuries and corporate bonds. This fund is designed to provide income and reduce overall portfolio volatility. The expense ratio is 0.03%, making it an affordable option for bond exposure. So, my experience has taught me that including bonds in a portfolio is essential for risk management. BND's low cost and broad exposure to fixed income can help stabilize returns during market fluctuations, especially when you want less risk, as for example a retiree. Distribution by credit quality is US government for almost 70%, AAA with 3.5%, and triple B, for example, with 13.2%. I don't go into further detail with this bond to keep it simple, but let me know in the comments below if you want to know more about bonds. Number of bonds in this fund is over 11,000, providing extensive diversification across the bond market. The BND has delivered a consistent performance with an annualized return of around 1.8% over the past 10 years. Launched in 2007, BND has achieved an average annual return of an approximately 3.13% since its inception. So why could this be a great addition to your portfolio? The BND provides diversification into fixed income, helping to reduce overall portfolio risk and offering a reliable income stream. So it's important to balance out your risk, but in most portfolios, I see that investors prefer bonds with maturities that are aligned to their personal situation. So these are the 5 best Vanguard funds currently available for various investment needs. However, you often don't need all 5 in your portfolio. Just pick 1 to 3 funds and that's all you need. So if you are looking for further guidance on the optimal 3 fund portfolio, you need to watch this video where I delve deeper into the best strategies for optimizing your investments across 3 investment buckets. See you in the next video.